investments in other companies, right? On the bus trip, you managed to read the chapter. Did you get the chapter read, I hope? No? This is a tough one, you guys. We're here at the end of the semester, right? It's easy to just let things slide. Not a good strategy, right? Keep reading, work on this thing over the weekend. Again, come to review if you can make it, and we'll cover this up some more. Anyway, so let's give this a shot. And then we've got a day. The quiz isn't until Wednesday, right? So we got Monday that we can cover, so cover it a bit too. Make sure by Monday you've really read this and you studied and you tried to follow. It's not very difficult once you see the picture. If you just try to memorize this stuff in that chapter, impossible. Okay? It's just way too much. So you don't want to get a good understanding of this. So what are the things that matter? What are the things you have to decide when you're going to account for investments in other companies? By the way, you guys know how to account for investments in bonds if you're going to hold them in maturity, right? Investment in held maturity bonds, you know how to do it, right? We just did it in the bond chapter. So that one you know, okay? But what if you invest in stock? That's what this chapter is about. And what if you invest in bonds that you're not going to hold to maturity, okay? So, same deal. And we account for them the same way. So what are the two things? Who did read this chapter? Okay, good. You can take one person. So what are the two things? What are the two issues you have to decide? It's only two, right? But critical. Okay? One is, how much do you own? How much of the stock? Okay? And how much stock you have is going to determine how much control you have over the company. And how much control you have over the company is going to determine how you account for it. That's it. Okay? That's one. And then the other thing is, how long are you going to hold it? How long do you intend to hold the stock? Right? And that's going to determine what type of an investment it is too. Okay? So those two things. Right? So you're going to ask yourself that question as soon as you see a problem, or in real life too, you know, you see an investment in another company, it's how much do I own of the company? What percentage of their stock? And how long am I going to hold that stock? Okay? And if it's bonds, it's just going to be, it's going to be just how long will be determined. Okay? Right? Because you don't have any control when you own bonds. Right? When you vote, when companies vote, the shareholders vote, bondholders don't, right? But you got the idea. All right. So what are the categories for how much you might hold? One share up to 20% is the rule of thumb. Okay? One share up to 20%. In that group, in that category, I'd say I have no control. When we vote, I lose. Right? If I own 1,000 shares and there are a million of them, people around the company don't even know who I am and don't care. Got the idea? Right? What if I own 2 shares? Even more so. Right? They just don't care. It doesn't matter. Okay? So I don't have any control of the company. That's the point. Now, this is just a rule of thumb. In some companies, if you own 20% and nobody else owns more than one, guess what? You're on the board of directors, and you consider yourself to have significant influence, and that's the next category. Okay, so it's a rule of thumb, but we'll use 20%. When I give you a problem, I'll say they own 1% of the stock or 2% or something like that. So it's obvious they have no control. All right? Between 20 and 50% of the stock, right? We'd say we have significant influence, okay? Significant influence. Author talks about that. Yeah, so 20 to 50% I have significant influence. So I get to help run the company. That's it, okay? Guess what? If it's over 50, up to 100% of the stock, when we vote, I win. Right? If you own 49% of the stock She owns 51%. What happens when you vote? She runs the company. 51, 49. Yeah, yeah. Now, she can't steal from you or something. You can always sue her, taking advantage of you, right? That sort of thing. But she makes decisions, right? That's it. Okay? So 50 to 100% is full control. And what we're going to do, guys, is we are going to account for it, the investments differently in those three categories. Okay? But it's easy to remember them because it's about control, right? That's it. Okay? So don't memorize it. It just makes sense. All right. What we're going to do, because we have no control here, we're going to use the market value method. And what that means, you may have heard the term mark to market. It'll be really cool when you talk to business people now. You know what mark to market is. Everybody likes to say that. All it means is you adjust the market value at the end of each accounting period. Okay? Do we keep most of the assets at market value in the financial statements? Land, building, equipment? No. We keep them all at what? Historical cost, maybe depreciated value even, right? Why don't we put them at market value? Wouldn't it be handy if all the assets were at market value and all the liabilities were at market value and therefore the equity was at market value?
It's inconvenient.
Inconvenient to do it. I think it's more than that.
Because value keeps changing.
It keeps changing constantly. When do you know what the market value is of a house? Really know. When you sell it. It's the only time you know. When do you know what land's worth? That's it, right? It's when you sell it. So how would we'd have to estimate all the market values using appraisals or something. Imagine UPS. What are they going to appraise all their airplanes and appraise all their trucks? What's the market value of all of UPS's trucks? I don't know. They don't know. They don't particularly care what the market value is of their trucks. Nor do I. They're not going to sell them. The market value doesn't matter. It's tough, isn't it? You know what? The only thing that I can really get a good market value for on the financial statements is their equity. I can get it real easy. You know how I can tell you what GE's stock is worth right now. How would I do that? Go out online, see how many shares are outstanding online, right? And see what the most recent sell price was. What's it trading for? Outstanding shares times the market value per share is called market capitalization, market cap. We can find out what GE is worth right now. So how useful is that piece of information? Not particularly. Doesn't mean much. So I can find out what the equity's worth, easy. I might even be able to find out pretty close what the liabilities are because what I could do is I could discount the future payments to the debt back to now at an appropriate interest rate and find out what that is. So then I can subtract the liabilities. That's easier than the assets. The liabilities from the equity, I know what the total assets are. But what useful information, what would be the use of that information? Not much. Very interesting, isn't it? Financial statements, what you use them for is to predict the future, you guys. What's going to happen to the value of the company as time goes on in the future. How successful they are, how unsuccessful they are, that sort of thing. Okay, really, what's going to happen, what the future cash flows are going to be. Okay, that's what we're going to use them for. So, market value isn't used for most assets because we don't know what market value is. Why do we use it for these? Because they're shares of stock and they're bonds. We know what they're worth. There's a market. They're being traded all the time. Got the idea? So we adjust the market value. Is that a good idea? Yeah, I think so. Why not? We know what the market value is. Why leave them at historical cost? Okay? All right. So we adjust the market value. So the way that you can make money if you own less than 20% of the stock is increases in market value and one other thing. You might have decreases, so you could lose something too, right? Okay, market value. Stock can change in value. And then what's the other thing you could have? They might pay you dividends. Yeah, so you could have dividend income, huh? That makes sense? So that's true. If you have significant influence, we're going to use a method called the equity method. And it's because as the equity of the company I'm invested in, which we're going to call an affiliate, okay, the equity, as the equity of the affiliate changes, my investment changes. So let's think about how you make money if you are helping run the company. How would you make money out of an investment where you help run the company? And you know what? When they pay you a dividend, that's not making money. That's paying yourself a dividend because you voted to pay yourself a dividend. That reduces your investment. So it's real different here, guys, okay, between these methods. So, you know, if I paid myself a dividend, I had less investment. Well, how would you have more value in the investment? You helped run the company. Your share of the income, you record as income. What do you do with the change in market value? Nothing. Because you're not taking what the market gives you here, right? You're helping run the company, is the idea. If you have control, you're called the parent. You own the other company. You're the parent. They are the subsidiary. Ever heard those terms? Large corporations might have hundreds of subsidiaries. They own at least 50% of lots of other companies. Okay? Parent-subsidiary relationship. Okay? What we're going to do here is we are going to consolidate. And what that means is I am going to combine the financial statements. So let's say I've got 100 companies that I own, right? We'd have two columns, debits and credits, right? For the parent. And then we'd have 200 columns, debit, credit, debit, credit, debit, credit, for the 100 subsidiaries in a big spreadsheet, right? So imagine an Excel spreadsheet or something, right? Huge. And then we'd have a couple of columns at the end where we add them all together. It's called consolidating. But when you consolidate, what you have to do is you have to eliminate the investment in the subsidiary, because otherwise on your balance sheet you'd say investing in yourself, right? Because subsidiary doesn't really exist, just the parent does, right? It's totally controlled. So we have to do what's called an elimination entry. And we'll do that, okay, probably next time. In the review today and then in class next week. Okay? What you do is you eliminate the investment, and then you eliminate all the equity of the subsidiary. Because the subsidiary doesn't exist. It's a strange thing. Okay? And that journal entry, by the way, doesn't go on anybody's books. It's not anybody's general ledger, because each company still has a general ledger. So if you had 100 subsidiaries, imagine 101, I guess, general ledgers, huh? So you do the spreadsheet, and you make this elimination entry, and then you do your financial statements, but you don't make the journal entry, I suppose. Okay? So that's kind of strange stuff. I think it's really something that this chapter, after you've read it, I hope you agree, that this chapter is in an appendix. I think they went crazy with it. I think they think it's too hard for you guys to understand, but the problem with it is it's too important for you to never have the exposure to. If you never do another financial accounting class, just do the managerial class, and that's it for your accounting. It's a disaster if you don't know what this stuff is. Okay? And you really want to know this. Okay? You want to know what's going on here. And for a variety of reasons. But how are you going to ever analyze a company if you can't understand their investments in other companies? You're going to have to You got to learn it at some point. Okay. So, what are we going to call these? Let's do that. What are we going to call these investments? If I have one share of stock up to 20%, what are the names of them? So let's say I'm going to have no control. For no control, what will we call them? These things are marketable securities, you guys. Because I'm ready to sell them, I guess. But within that, I am going to have three different names, okay? And those are going to be based on how long I'm going to hold it. So this is where the how long comes in. So it's the no control category, okay? One share up to 20%, say, approximately, okay? No control. We call them a trading security. If you are going to hold it for up to a few weeks. So a few days, up to a few weeks, max. Trading security. do you need to know? Yes.
Securities that what? The ones that the team.
Trading security. So what's the deal for it to be a trading security? I own less than 20%, I have no control, and I'm only going to hold it a short period of time. Got it? Trading security. So the question you ask yourself is, how much do you own? And then how long? Okay? If it's less than 20%, how long? Then if it's up to a year, we cleverly call it available for sale. Available for sale securities, okay? Short term. What do we mean by short term? Less than a year. So they're easy, right? Available for sale, short term. Another category, it's pretty simple. Available for sale. Guess what? Long term. Okay. Over 1 year. All right. What do we call it if we have 20 to 50%, and we think we have significant influence now? So these were down to the trading security, available for sale, short-term, long-term, were all no control. What if I own 20 to 50%? I have significant influence. What am I going to call it? Investment in affiliate. Okay. Investment in affiliated company. Right? And we're going to use the equity method with that. Okay? And then guess what you call it if you own 50 to 100%? Cleverly, I own a subsidiary, so I call it investment in subsidiary. Really, with this chapter, you start getting a really good idea why we call things what they are. A lot of different ones, huh? So you're going to need to be able to handle 1, 2, 3, 4, 5 types of investments. Okay? By the way, why don't we worry about how long we're going to hold an investment affiliate or investment subsidiary? Let's say you own 40% of the company. You're up in here and you own 40% of the company. Think you're going to sell it in a few days or a few weeks? Think you're going to sell it within a year? No. If you try to do that, what's going to happen? Sell 40% of the company to the stock market in a few days. Man, the bottom will fall out of the price. It was a fortune. Nobody can do that, right? You have to arrange to sell it to some other company or sell it real slowly or something. Yeah, so those are non-current anyway. How about an investment in a subsidiary? It's even worse. You own more than 50%. Got the idea? So certainly these are both long-term. We don't have to call them long-term. They just are. They'd be a non-current asset. Make sense? So those are the categories, huh? So what are you going to ask yourself when you read a problem? Yeah, what percent ownership do I have? How long am I going to keep it? That's it. Once you got that, you can count for this stuff. Okay, that's the first thing you do. Let's say, let's do an example of this. Let's say that I've got a company with 100,000 shares, stock outstanding. But one other thing, what if it's bonds? They said this is for stock and bonds. What if I invest in bonds? How much control do I have? None. So what categories will they go in? No control, you got it. If I'm going to hold them for just a few days, trading securities. If I'm going to hold them up to a year, or more than a few days, those still short term. Going to hold it for more than a year, they'll still long term. I'm going to hold them to maturity, investment in health and maturity bonds. You already know how to do it. That's all the categories for bonds, huh? Okay. Everything fitting together here? Pretty good? Okay. It'll help after you read the chapter. All right. Okay, anyway. Some people think that we really should cover material before you read it. I think it works better the other way around. It's bad enough if you have read it. Good stuff. Get it read, please. Okay, anyway. Only a few chapters to go, you guys. So let's say there's 100,000 shares in the company. Let's say the market value at the beginning, when I buy it, 10 bucks. Market value at the end of the year is 11 bucks. Okay? What are the two things you'd like to know? How much and how long, right? Okay. Let's say the net income for the company this year is $200,000. Good year. Stock's only in total $1 million when we bought it, right? Okay, 100,000 times 10. And let's say we pay a dividend of 40,000. Okay, that's total for the company. That's what the company does during the year. So during the year, the stock value goes up by $1. You see that? And the company earned 200,000 and paid a dividend of 40,000. Okay? And of course, I'm going to get some of the dividend because I own some of the stock, right? So let's start with 1,000 shares. Let's say I have 1,000 shares. Buy 1,000 shares. What's the first thing you're going to ask now? How much is that? What's 1,000 out of 100,000? 1%. What do you got? A marketable security, huh? No control? You buy that? Okay? So what do you want to do? I want to ask one more question. If it's less than 20%, I want to ask the other question. What is it? How long are you going to hold it? It's that simple, right? It looks really hard when you read this chapter. Whoa, what's going on? But it's that simple, okay? How long are you going to hold it? Okay? And what are the three categories that I'm going to worry about? Is it only a few days, up to a few weeks? Or if it's more than that, is it less than a year? Right? Or is it more than a year? Okay? So let's record buying this. Let's say it's a few days. Okay? I'm going to hold it for a very short period of time. What am I going to debit when I buy it? By the way, what do I give them for this stock? It's probably cash. What are you going to do to cash? Probably credit. So it's no big deal. Credit cash how much? 10 bucks a share on 1,000 shares. How much is that? 10,000. Right? Debit what for 10,000? What do I want to call it if it's only a few days and I only have a few shares and a small percentage? Trading securities. That's it. Investment in trading securities. I'll take just trading securities if you want. Okay? Investment in trading securities. Typically call it. Type of marketable security, huh?
So this would be on our sheet, not the company's.
This is the company that bought the stock, not the company that issued the stock. Right? And you might have just bought it in the stock market, by the way. You don't have to. You could buy it from some other owner. You don't have to take it from the company. Although if the company issues it to you, it'd be the same issue. So that's a good question. Okay, how about if it's up to 1 year? More than a few days, but up to a year. You got it. This is too easy. Available for sale long term. Would it still be 10,000? Of course, right? That's what the deal was. Okay, going to hold it longer. So you decide how long you're going to hold it, and that's how you record it. Okay, and credit cash. I'm going to actually give you points for this, you guys. Okay. People who have read the chapter and practiced this a little bit are going to nail it. Yes.
Why is it available for sale long term?
Oh, I'm sorry, it's short term. Thank you very much. It is because Keith screwed up. Very good. Short term, thank you. Yeah, less than a year short term. Okay. Thank you, thank you. What if it's more than a year? Yeah. Available for sale still. This is too easy. But we call it what? Yeah, unless your Keith, give them back. Okay, exactly that, right? And then credit cash. Is this hard so far? No. There's just a lot. Not real hard. Okay. So then let's say that we have this increase in value of $1. What do you want to show on your balance sheet now at the end of the year for this investment, regardless of which one of the three you've got? What do you want to show on your balance sheet at the end of the year? How much? You want to go market value, right? We are going to use the market value method. We are going to mark the market. So what does that mean? What's the stock worth at the end of the year that I own? 11,000. Bought it for 10, it's worth 11. What do you want to show on your balance sheet? 11. How do you make that happen? Make a journal entry. What do you want to debit trading securities for? How much? This is for the increase in market value. What are you going to do?
1,000.
Debit trading securities for 1,000. Everybody agree? That 10 now becomes 11. That's all there is to it. And we're going to credit a brand new type of an account, okay? This thing is going to be called unrealized gain on trading securities. What's that? What does realized mean? This is unrealized. What does realized?
Recognize.
Well, recognized means recorded in the financial statements. So we're going to recognize this because we're making a journal entry. But it's not realized. Recognition of something is you see it, you recognize it, right? It's putting it in the statements. When you make a journal entry, you recognize it, okay? Recognize assets, liabilities, equity, right? Revenue, expense. So we're recognizing the gain, but that's good. Recognition is really connected to realization. But what's realization? I realize something. I got paid. The cash changed hands is realization. We recognize the sale when we debit accounts receivable and credit sales. Remember we talked about that? You realize the cash when they pay you. You debit cash and credit accounts receivable. Remember that? Realization is getting paid. Everybody good? Okay.
So when you get paid, you eventually debit it?
Well, we will realize the gain when we get paid. And yeah, if it's an available for sale one, then that unrealized gain will go away and it'll become a realized gain. Okay? With this one, it's a little bit different. So you got the idea why it's unrealized though? You don't have the cash yet? Okay? I didn't sell it. By the way, do you really have a gain? If you didn't sell it?
No.
Kinda, right? Think about this. When the stock market was, it went down by 50% back in 2008. Bottom fell off. My wife and I lost half of what we were worth. Everybody did in the market. Lost half of what you were worth. But I told my wife, well, we didn't really lose it. She says, well, what do you mean? Well, it's kind of overvalued before. Now it's kind of undervalued, but I got it recovered. Now it's worth 3 times as much. Market dropped 12 to 6. Now it's 18. So did we lose the money? If it sold, we would have. Some people sold. They lost, right? And we did lose. I mean, if you were to do a balance sheet for yourself, wouldn't you put it in there at market value and you're worth half as much? Yeah. And then we gained it back, right? It's really fuzzy, isn't it, you guys? So this is really a good thing to look at, too, is to think about, well, what's real here? It's a real gain. They made money, but they haven't realized it. So we call it unrealized, okay? But this could be pretty significant, couldn't it, for companies? Imagine a company has $100 million investments in other companies, and then the bottom falls out of the market like that. How much do they lose? They have $100 million, they lost $50 million, right? And they need to put it in their financial statements, okay? So, because we want to mark to market, adjust everything to market. Okay, so it's a real gain. It just isn't realized yet. That makes sense? So we're going to recognize it. Now, a key thing with this was a political compromise here on how to handle this. This unrealized gain goes on the income statement, just like every other gain and loss. By the way, what if the stock value went down? What would you have? You'd have to credit trading securities and debit unrealized loss. Got it? This one goes on the income statement, which is the reason why you won't see very many companies with trading securities. It goes to the income statement. On the other two, this is what makes this kind of complex. On the other two, the available for sale short-term and the available for sale long-term, the gain or loss is not going to go to the income statement. When you do the entry, it's going to be debit available for sale, short-term, Still 1,000, right? Because it went up to 11,000. If that's how we record it in the first place, I would put the 1,000 in there. It'd still be unrealized gain. This time on available for sale short term. Got the idea? Pretty simple journal entries. But here's the deal. This one goes to equity. Straight to equity. If you put, by the way, you put this unrealized gain on the trading security into the income statement, of course it'll get closed to retained earnings, right guys? Just like any other gain or loss or revenue expense, it gets closed to retained earnings. So it'll end up in equity and retained earnings. This one is going to go directly to equity in something called other comprehensive income that you'll read about. And it's really important, one of the advantages of doing this chapter, it's really important for you guys to take a look at other comprehensive income. It's going to be straight into the equity statement, not on the income statement, okay? So all the company has to do to keep the gain or loss, by the way, companies like the gains, the losses they don't like. They don't want the loss in their income. So to keep it off the income statement, all they have to do is decide they're going to hold it for more than a few days. And it's a judgment call anyway. So you'll see very few companies say they have trading securities. What will it be if it's going to be long term? Available for sale, guess what? Long term. That's exactly the same, and it's unrealized gain or loss, depending on which direction it goes, on available for sale. Long term. Other comprehensive income. Yeah, we'll talk about it. Other comprehensive income. It's a whole section of the equity statement. We'll talk about that some more. So those entries look exactly the same because they are. It's just one's short term, the other one's long term. Got the idea? Same deal. Okay. Now let's talk about other comprehensive income. Let's go ahead and do that. I kind of lied to you guys again. Keeping it a little bit simpler. What kinds of equity are there? We said there are two types of equity. Retained earnings is one, and common stock and preferred stock are attributed capital, guys, right? Okay. There's one more. Other comprehensive income. Okay? And here's what happened. When they decided to start using mark-to-market accounting, adjust those investments in other companies to market value at the end of each year, everybody agreed that we ought to put market value in the balance sheet. But we couldn't get agreement on it. Remember back in chapter 5 it said that accounting is all a political process. Until it is. Human beings figuring out how we're going to do stuff, right? So it's all negotiated, right? Actually even voted on. So, there's a lot of discussion, and companies like the idea of showing market value in financial statements, so they don't want losses in their income statement. So the compromise was, well, we'll go straight to equity. We'll just put it into equity in this other comprehensive income category. So when you look at an equity statement, you'll see the contributed capital, right? Column for that. You'll see one for common stock, one for additional paid-in capital, preferred stocks, so columns for all of them. And then you'll see retained earnings, column for that, right? Where you add the net income and you subtract the dividends. You got to know how to do that. And then you'll have another column, other comprehensive income, right? And it just goes straight in there and sits there. That's where all these unrealized gains and losses are going to be. Why is it important for you guys to know about this? Well, what if the company has a massive loss? What if the loss is bigger than their retained earnings? You want to know about it? You won't know about it on the income statement, you guys. You won't know about it on the balance sheet in particular. Right? I mean, there'll be one line there. But you need to know what other comprehensive income is. Keep that. Okay? So stuff that doesn't go anywhere. But this isn't the biggest one. There are a couple of others. What if a company has a bunch of cash in foreign currency? So the value, the exchange rate between the U.S. dollar and the foreign currency changes. Right now the dollar is real strong. What do we mean by that? It's worth more relative to foreign currencies, right? What does it do to foreign currencies? They're worth less. What if you're holding a whole bunch of foreign currencies? You get losses. Yeah, you get losses on it until it recovers if it does. Right? By the way, is it good or bad to have a strong dollar? And it's everybody always says things are bad no matter what. It's like, you listen to people in the financial press. Oh, what's bad about it, strong dollar? When you are buying foreign goods, what happens? You can buy more of them. That's not bad. That's good. Oh, what if you're trying to sell your goods overseas? They're more expensive, so it's harder for us to sell. So what happens? We tend to import more and export less, and that's kind of our only job, right? So it's moving the value makes a difference to the overall economy, absolutely. Okay. So where would we put those gains and losses we suppose on foreign currency? They go straight to other comprehensive income, so you can see what your exposure is on that, and that's where you'll find it. And then there's one that's really massive for some companies. Unfunded pension obligations. We finally decided that we were going to record liabilities for pensions that companies had promised to their employees. What happened was, back when there were lots and lots of unions and they were really powerful, the union would negotiate with the employer on how much was going to be contributed to the pension plan. And then the union would promise the employees a pension, right? And the problem was the amount that got contributed to the plan in lots of companies was far less than the amount they promised the employees. So who owes the employees that money? The retired employees. Billions of dollars across the economy. Who owes it? The company did, right? Except then the companies went broke. Now who owes it? Taxpayers. And the employees got 30 to 50% of their pension, and taxpayers get to pay for it. So we wanted to tighten this thing up, and they passed laws that require adequate funding, right? Congress did finally, after the problem's huge, right? So they started funding the pension plans. And what happened was these were defined benefit plans, they're called. So no matter what gets put into the plan, you get a certain amount when you retire, right? You count defined benefit. Changed all the plans to defined contribution plans. What do you suppose that is? The company agrees to contribute as much as they're going to contribute. They contribute it, right? They decide how much you're going to put in. They put that much in, right? They're not unionized. They just put it in, right? And they're done. Whose problem is it how much is there for the retirement? The employee. The risk got transferred to the employee. Okay, so all new pension plans are like that, right? Very few people have defined benefit, but they're still around. So what we did was we credited a huge liability here, but what do you debit then? Huge liability for pension obligation. What do you debit then, guys? Retained earnings? Losses? What? More expense? Should have been compensation expense over the years. Pension expense. So what they did was they plugged into other comprehensive income. So you look at some companies, they have a pension obligation that's massive, and they have other comprehensive income that is bigger than their retained earnings. The trucking industry, almost all of them are broke. And people started new trucking companies that owe the pension, right? And all the truck drivers just lost their pensions. Got the idea? So this is a mess. This is a real mess. So anyway, another political compromise. So that's another comprehensive income too. So does that kind of answer what this stuff is? Okay. So take a look at that. Think about it. It's pretty important. Okay. Pretty big. All right, guys. Well, what would we do then with our net income? What do you think about your net income? How do you earn money if you have no control? How do you earn profit out of this company with no control? Yeah, the increase in market value is income, and dividends is income for you, right?
Yeah.
But you're not making the net income, so no entry. So here, no entry. Now when we do the other method, the equity method, we're going to record our share of that income. But because we don't control this company, no control, we're not going to record anything. Got it? What about the dividend, however, though? Well, we got the dividend, right? So regardless of which method you use, whether it's a trading security available to sell short-term or available to sell long-term, it's going to be exactly the same for the dividend. And what's the dividend going to look like, guys? How much dividend do we get? What portion of this company do we own? 1%. And how much dividend are they giving? So how much do we get? $400. Right? Everybody agree? You could take 40,000 and divide it by the 100,000 shares, it's 40 cents a share, right? Times 1,000 shares is $400. Fine. Got it? Or just take 1% of the 40. What did they give us? Cash. I bet you can do this. You already know how. Debit cash 400 and credit what? Dividend revenue. You already knew how to do that, didn't you? Okay. So how much would we make off of this company this year? 1,000 for the increase in market value and 400 for the dividend. Okay? Got it? Now, if I was going to do equity method, what would I do? With the equity method, I am going to record my share of the income as income. My share of the dividend in the equity method is a reduction of my investment because I'm paying myself a dividend, and I would do nothing with the market value because I'm not taking what the market gives me, right? I'm using the equity method. So how's that going to look? Give that a shot. You got it. Okay. Let's do the equity method. What changes here? It's terrible having ball games right before a tough chapter. You guys are all sitting there. What is he doing? Yeah, it'd be better when you brought it. You got 100,000 shares, you guys. $10 was the market value at the beginning. $11. Whatever it is, right? This time, how much would I need to buy? More than how much, guys?
20.
More than 20% or 20,000? So let's say 30%. How many shares am I buying? 30,000 shares. Everybody agree with that? Okay. And let's say my net income is still 200,000. And my dividends, I decided to pay 40,000. And by the way, I'm helping earn that net income, right? Because I own 30% of the company. I'm helping run the company. So 30% of the income's mine. That's what we say. And I also paid myself 30% of that dividend, right? I paid it to myself, okay? Versus the market's giving it to me, right? The company's giving it to me. Okay, so how would we record this when we buy the stock? Credit cash, how much? 30,000 shares at $10, how much is that? This is easy, isn't it? And then using the equity method, I call it an investment in affiliate or affiliated company. Okay? Investment in affiliate, 300,000 debit. Nothing to it. Okay? Equity interest in affiliate or something. However you use different terminology. Okay, there's a lot of different terms people use for this. So there's investing. Now what would I do at the end of the year? What do you want to do with the market value change, guys? Nothing. No entry for that. So you see the difference between no control and significant influence? Huge, right? Big difference. No entry for that. What do you want to do with the net income? Oh, I earned what? 30%. So I'm going to increase my investment. Increase that investment in affiliate. For how much?
6,000.
Yeah, 30% of the 200. 60 grand. So now I think I have a $360,000 investment. Everybody good? And credit? Credit what? Yeah, 30% of the 200 is the 60. And I think my investment went up because I earned. Make sense? So investment in affiliate. 300 comes in when I bought it. In this example, another 60 for the net income goes in. But what happens when I pay a dividend? Oh, what do I call that? But equity interest in income of affiliate, all kinds of screwy names. You guys can just use income from affiliate. A lot of times it is equity interest in affiliate income or something like got the idea? Where does that go, by the way? That's on the income statement, okay? Everybody good? What would I do with the dividend? Now, dividend's not income to me, but do I still get paid the dividend? Sure. So I have to debit cash, don't I? How much would I debit cash? Yeah, it'd be 40,000 times the 30%, wouldn't it, everybody? So you get 12,000 cash. And what do you want to credit? I gave myself back some of my investment, okay? Actually, I made 60 and I took 12 of it out. Does that make sense? Just like retained earnings. Net income gets added to retained earnings, right? Here, our share of the net income increases our investment. So as the equity of the subsidiary, or I'm sorry, as the equity of the affiliate changes, goes up to the income, I increase my investment for my share of that. It goes down when they pay a dividend, right? It comes out of retained earnings. I take my share of that, take it out of the investment. So there it is. It's going to come out of investment in affiliate. Same account, guys. This is the same account. See it? So what would I have in the investment? It would be 48, which is the 300 I invested, 60 I earned, 12 I took out. Everybody good? Go away. Get some rest. Read the chapter. Show up for the review. Make it. What time's the review? 2 to 3? Go to what that? I'll record it, of course.
Is there gonna be sound this time?
God, I hope so. I figured out what was wrong, did I tell you? Somebody went into this thing, there is a command you can do that says advanced levels. They clicked on advanced levels, went to wireless mic, and turned it off and left everything else on. They lowered it all the way down to 0. Well, that's what we're using to record.
We love technology.
Why would somebody do that?